In this presentation, we will record an advance payment or a customer deposit. In other words, we're going to receive a deposit in advance for a guitar that we're going to provide in the future. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. Let's first take a look at a flowchart. I won't spend as much time on it because we've seen it in the past. What we really want to do here is put that negative receivable on the books, which we'll be dealing with in our adjusting entry process later. The process here, note that the normal accounts receivable process is to have an invoice, then we receive the payment, then we make the deposit. Here, we're going to say someone came into our shop, says they want a guitar. We can't give it to them at this point in time, but we will hold on to it for them if you give us a down payment to show commitment that you're committed to the sale. Therefore, we're going to record the receive payment before the create invoice, and you can see the arrows going from left to right, and we're just basically doing it from right to left, which is the opposite of what we would typically do. So that's going to be unusual in that we're going to basically have a negative receivable. We're not going to be recording a liability. We want the negative receivable because logistically that's going to be easier for us to work with. It will create a timing difference, however, where our financial statements aren't technically correct on an accrual basis, and we'll do an adjusting entry to reflect that at the end of the month in the another section of our course. So now we're going to be back in our Get Great Guitars. We're going to say new, and we're going to be into the money in, and we're going to choose this receive invoice payment. So we're going to be receiving an invoice payment, even though an invoice has not yet been made. We're going to be putting this to string music. So string music, and there it is. We're selecting string music, and once again we get this pop-up saying, hey, I'm paraphrasing, we don't have an invoice related to the string music at this point in time. How did you receive a payment? Because usually you have an invoice and then a payment. And we're going to say that's okay because we got paid before the invoice for this particular point in time, and we're going to make the invoice later. The date's going to be the 21st, so I'm going to say 21st here for the date. And note there's no invoice down here like typically is the case. Usually there's an invoice and we check off the invoice, and that would be the matching the amount that would be paid. But this time we're just going to put the payment even though there is no invoice. That will create basically what they call a credit for an overpayment that we need to apply out for this particular customer. So I'm going to say save and close, and it's going to give us this thing. It says you didn't select an invoice. We'll save this payment as a credit to your customer. So that means that the next invoice we'll make will basically apply out that credit. That's what we want to do, so we're going to say save and close. Thanks for doing that, QuickBooks. And then we're going to go down and see what happens by going to our reports down below. Let's open up our reports. We're going to open up the trusty trial balance. So let's put in the trial balance in the old search field, and there it is. There's our trial balance, which is nice and trusty. We're going to go back up top. We're going to change the dates up top from 01/01/20 to 12/31/20. That's January through December 2020. Run that report. And then we're going to duplicate the tab up top by selecting the tab, right-clicking on it, and duplicating it. So now we've got the tab on the right. The other report we're going to want, I'm going to go back to the left, is going to be the customer balance detail report. So before I zoom in the screen, I'm going to go back here to the customer balance detail report. We're going to scroll on down to the amount people owe us. That's the section it's in, who owes you money. And we're looking for the customer balance detail. That's the one right there, the customer balance detail report. Okay, so now I'm going to go back to the trial balance, and I'm going to close the hamburger. I'm going to make this a little larger by holding down Control and scrolling up till it's at that 125, 125. Then let's take a look at the accounts receivable. Let's go into that accounts receivable. And if we scroll on down to the bottom of the accounts receivable, we'll see that payment that we have, that payment of the $300. Doesn't look funny really in the transaction detail report because it could make a payment anywhere, but notice it doesn't match any invoice up top. So it looks fine here, but if we then go to the detail report, if I go back to the trial balance, because you'll note the AR is still positive, so it's not like it made the accounts receivable negative. But if I go to the detail report then, and I close the hamburger here, and I scroll down to the bottom to string music, I see this customer saying, is there negative accounts receivable? That doesn't make sense. Negative accounts receivable, why? How can an accounts receivable means people owe us money. How can it be negative? That would mean we owe somebody else money, which we do because they gave us a deposit, and either we owe them the deposit back or we owe them a guitar. Therefore, it's a liability at this point, really, which really should be in some kind of liability like unearned revenue or deposit or something like that. However, logistically, that doesn't really work as well because we can't track the customer. We want to track the customer under the account of accounts receivable because that's the account that tracks the customer. Therefore, logistically, it works great to have this negative receivable. Now, what happens when we run the report at the end of the time period and we want to make our financial statements correct on on an accrual basis? Well, then if we still have these negative receivable in there at that time, if it hasn't cleared out, if we haven't gotten the invoice at that point in time, we'll just simply make an adjusting entry for it, and we'll see that in the adjusting entry process. When we do the adjusting entries, in other words, we'll increase the accounts receivable by that 300, we'll increase the a liability by 300, and then we'll simply reverse that right afterwards so that we can be correct as of the end of as of the cutoff date, as of the report dates for adjusting entries, and we can still use this logistically useful tool of tracking this information in the accounts receivable and by customer